Gap trading involves the idea of taking advantage of the times when a stock's opening price is notably different from its closing price the previous day. Willing to know more about market gap up or gap down? A gap up occurs when a stock opens at a higher price than its previous close. Introduction to gap trading. Gap trading involves identifying and exploiting price discrepancies between trading sessions, particularly when a stock's price jumps significantly at the market open. It involves recognizing these price gaps and implementing strategies to capitalize on potential opportunities. Understanding different types of gaps. Common gaps. These are small, insignificant gaps that quickly fill, often caused by normal market fluctuations and low volume. Trading opportunities are limited due to the lack of significant price movement. Breakaway gaps. These gaps mark the start of a new trend, breaking through resistance or support levels. They occur due to significant news or a change in investor sentiment. Trading opportunities exist in the direction of the gap. Runaway gaps. These gaps occur within an established trend, indicating strong momentum. They are driven by continued positive or negative sentiment and high demand. They reinforce the existing trend and offer opportunities to add to positions. Exhaustion gaps. These gaps occur near the end of a trend and signal a potential reversal. They represent the last surge of buyers or sellers before the trend ends. Caution is advised as they require confirmation of a reversal. Identifying gap trading opportunities, scanning for stocks with significant gaps, e.g. greater than 3% or greater than 5%, using stock screeners to filter by gap percentage, volume and other criteria. Analyzing the news and events that cause the gap, earnings, announcements, etc. Considering the overall market trend and sector performance. Key technical indicators for gap trading. High volume confirms the strength of the gap, e.g. 50% above average. Gaps often occur near key support or resistance levels, Fibonacci retracement levels, pivot points. Moving averages, 50-day and 200-day, confirm the trend and identify potential entry/exit points. Relative Strength Index, RSI, helps identify overbought, oversold conditions. RSI greater than 70 equals overbought, RSI less than 30 equals oversold. Moving Average Convergence Divergence, MACD, provides insights into trend direction and potential reversals. Gap trading strategies. Examples: gap and go. Enter a long position after the gap up, expecting continuation. Set a stop loss below the low of the gap day's opening range. Example: buy a stock near the open after a 7% gap up on earnings. Stop loss 2% below. Reversal gap. Identify exhaustion gaps and trade in the opposite direction. Look for confirmation, e.g. bearish candlestick pattern. Example: short a stock that gaps up but forms a doji, stop loss above the doji high. Gap fill, bet on the gap filling, price returning to pre-gap level. Enter a short position after a gap up, expecting a pullback. Set a stop loss above the high of the gap day's opening range. Example: short a stock near the open after a 5% gap up. Stop loss 2% above. Risk management in gap trading. Use stop loss orders to limit potential losses. Set appropriate position sizes based on risk tolerance, e.g. 1 to 2% of capital per trade. Avoid over-leveraging as gaps can be volatile. Be aware of overnight risk, as gaps can change drastically before the market opens. Case studies: successful and unsuccessful gap trades. Successful: stock XYZ gaps up 10% on FDA approval of a new drug. High volume confirms the breakout. Enter a long position, set a stop loss below support. Stock continues to rise, generating a 20% profit. Unsuccessful: stock ABC gaps down 8% on negative earnings. Enter a short position, expecting further decline. However, the stock quickly reverses and fills the gap. Stop loss triggered, resulting in a small loss. Conclusion: mastering the gap trading strategy. Gap trading can be a profitable strategy with proper knowledge and risk management. It requires understanding different gap types, utilizing technical indicators to confirm entry, exit points, and prioritizing risk management. Continuous learning and adaptation are key to long-term success.